our first iteration of that was what we call Widget 360. Watch what happens. I clicked on implied volatility, Widget 360, ink, and let me know if you can see this. Yeah. No, you know what? I don't want to do it on crude oil. Let's do it on something tamer like Microsoft. Okay, MSFT. And let's see. Coming through. One moment, please. There we go. Applied volatility, Widget 360. So what I have now is a graphic representation of the call implied volatility and the put implied volatility. I can uncheck what I don't want. I don't want to see Feb, and I don't want to see the Jans. I'll see March, April, and July. Okay, and I can see, let's see, can I mix these together? Just the out of the monies. So this is what you used to see on the volatility analysis page. We have moved it to the Widget 360. Think about what the volatility analysis page was. It was simply an XY graph, a representation of data. It just showed you the implied volatility across the strikes. That's what Widget 360 does. You want it in a slightly bigger format. It's on Tools also. Okay. So I can go MSFT. All right. But what you're seeing now is the open interest for Microsoft, not the volatility. Let's go back and change the, where do I change it? The volatility. Well, let's do extrinsic value. Let's do probability of expiring. Okay. So what I can do now is graph not only implied volatility, but any of this data that I'm choosing down here. Open interest is always popular. Where's the open interest in Microsoft? I can do it on the trade page as well. I simply change my column to open interest. Click on this, Widget 360, and it shows me the open interest for the calls, open interest for the puts, and sure, where's Microsoft right now? About 28 bucks. You'd expect most of the open interest to be gathering around the 27.5 and 30 strikes. That's exactly what we're seeing. I can choose out of the money options. Okay, so I don't want to see the in the money, so that concentrates it around, again here, around the 30 strike. There seems to be a predominance of open interest in this area between 27.5, 30s, 32.5. So what we did was we took what was kind of an underused piece of functionality, the volatility analysis page, which was simply a XY chart. The x-axis had the strike prices, the y-axis had the implied volatilities, and that's all it was. People going, the volatility analysis sounds great. Well, there wasn't a whole lot to it. When we were acquired by Ameritrade, we said, well, what does their Option 360 platform have? Well, it had they graphed things kind of interesting. We'll say, hey, we could do that. Let's just incorporate it right in the trade page, right where people want to see it. So, oops, there's the open interest. I click open interest, see it, there it is, close it, do my analysis there, close it, and I'm back to trading. Okay, so what the Thinkorswim approach is incorporate it all into the platform. So you don't have to go from product to product to product, or tool to tool to tool. We have it right at your fingertips. And as I said at the top of the presentation, beginning of the presentation, is that if the hotkeys work for the active trader, we'll start to expand that, like I said, to other things, probably Widget 360. You want to see a quick snapshot, hotkey, bang, there's your implied volatility graph, there's your open interest graph, hotkey, close it. So that's where we're headed with the platform. Any questions at this point? Matthew, as I say, any questions, comments, ugly recriminations? What's going on up there in Michigan?
I've got several questions online, and then I don't know how much time you have, but
I have a few minutes, probably about 5 or 6 minutes or so. And I have to head downstairs for a meeting. But go ahead. What's coming up?
All right. Let's see. We've got a question about ThinkMoney.
Yep.
In the second to last issue, ThinkMoney, you showed an example of finding prices of strikes 2 strikes below the current prices, and also prices of strikes 2 strikes above the current price. Could you explain that?
I'm sorry, it was the, and I wish I remember the article specifically. The problem is I'm in the middle of writing the next version of the magazine right now. It was Iron Condors, did you say?
I didn't. It just said it's the second to last issue.
The second to last issue, it talked about selling options 2 strikes away.
Let's see, finding prices of strikes 2 strikes below the current price, and also prices of strikes 2 strikes above the current price.
Let me see if I can interpret that a little bit. And I'll be very honest, I'm sorry, I don't remember exactly what the article was. But what I mean, the general approach we have at Thinkorswim is, and this is stuff we've been doing for years, even before we built Thinkorswim, and before we had all these tools built in a platform, is we'd say, okay, if I'm going to do a covered call, let's say in Microsoft, well, I'm going to buy the stock, sure, $28. What option do I sell? Well, the basic criteria that we always start with, and this is not something that, again, this is not going to say you're going to make money doing this. This is not the be-all and end-all strategy, and not something that you are prohibited from ever changing yourself. You may say, well, that's the way the basic criteria is, but the 120 people up in Michigan, heck, you have your own way of thinking about trades, but the whole 1 to 2 strikes out of the money would be, I'm going to buy the stock here, and if the stock right now is at 28, then maybe I'll sell the 30 call. What that does is the way we see it is, if you pick an option that has about a month to expiration, as the March is due now, they have 34 days, pick a strike to sell that's 1 to 2 strikes out of the money that balances, and I'm not talking about any numbers. I'm not talking about specific probabilities or time decays or anything like that. I'm not looking at any ratios. I'm just saying intuitively, to me as a trader, it balances the amount of time decay I can collect, positive time decay I can collect, and probability of keeping that money. All right. So I may say, if I'm bullish on Microsoft, or if I don't think it'll drop, I'll just sell a put. In other words, I'm not going to buy the stock. I'll just short a put, and if it drops down, fine, I'll buy it at a lower price. So 2 strikes away, well, I could sell the 26 puts at 30 cents. Okay, that balances a probability of, it's probably, I don't know, I'm going to guess probably about a 60 to 65% probability being out of the money. Let's see how close I am on that. I'm just kind of guessing. Yeah, okay, the 26 is they're about 75% probability, so even higher. So it's got about a 75% probability. What's the time decay on those? Okay. Very simple to do, click, 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 and theta. So I'm collecting a penny a day so far, which makes sense because of the 30 cents and 34 days to go. But I'm collecting about a penny a day, and there's about a 75% chance of keeping the money. It's, so if I'm going to short a put on a stock that I like, 1 month, 2 strikes away. Or 1 strike away if you want to be a little bit more aggressive. So Iron Condors, Spider, you just, if you're not using the probability numbers, if you're not doing anything like that, fine, just a couple of strikes away. That's the rule of thumb. That's the basic approach that we have used. And that conforms ultimately to a lot of the probability stuff that we look at as well. I don't know if that clarifies things at all, and I guess I'd have to revisit the article. I don't remember what I wrote.